Hi everyone, as ever, really grateful that you've tuned in. We're talking all things property and all things finance in this series, and I've been joined today by Tom Atley. Tom, good to see you. We've chatted before. I know you're one of the big brokers at Trussle, and we're super pleased to be working with you guys through this series. This topic, how to get a low deposit mortgage. There's so much chat. There's always so much chat about levels of deposit and how that influences lenders' decisions. So I wanted today, if we could, just to dive into that topic a bit. How do you get a decent mortgage if you've got a low deposit, and the things that you can do to improve your chances, as it were? Definitely. It's difficult, isn't it, getting the deposit together? That's the first big challenge.
So hard to get a deposit together now when rents are so high and utility bills and energy prices are so high. So to save and live a life, and have a social life as well is very difficult. So there are a few government schemes that you can look into, which we can talk about. Previously you would have needed to save up a 10 or a 15% deposit to buy a property, which in London can mean sort of 50,000 plus, which is just completely out of the realms for a lot of people. However, now you can get by with just a 5% deposit, so that's probably the easiest way. So if you can scrape together a 5% deposit plus obviously your stamp duty and relevant moving fees, there are lenders that you can approach to do that. You just need to be wary that you'll be paying a higher interest rate. The lenders are going to ask a few more questions of you. You're going to need to have a better credit score, and you're going to need to pass a few additional checks if you've only got a 5% deposit, because you represent an additional risk to the bank.
Yeah, I completely get that. The banks they're in business to lend money, but they will assess risk versus return and how much of a risk you are. And I guess if you've got 15% deposit and they've got a charge over the house, you are a smaller risk than if you've only got 5% deposit. But are you saying it actually affects the interest rate that they'll lend you the money at?
Yeah. So the interest rate is higher the slower deposit, the smaller deposit that you've got. Yeah. So the headline rates that we've seen in the past of sort of 0.99%, those were only really available for people with 30 or 40% equity in the property. You wouldn't get that with a 5% deposit.
I just wanted to take a moment in the middle of proceedings here to say a very big thank you to our friends at Trussle.com. They are the sponsors of the whole series. Trussle were the first online mortgage broker, and they've indeed since been voted the best mortgage broker. Not just online, but the best mortgage broker. They are a hassle-free, fee-free way of getting a mortgage, and indeed they are the only broker with a 5-day speed promise. I'm just thinking, I'm going to put you on the spot here, for which I apologise, but just looking into the future, do you think this current situation will remain? Because it wasn't that long ago you could get 100% mortgage.
When I first started broking about 15 years ago, I could get 110% mortgage.
Yeah.
You'd buy the house, you'd have some money left over to build a conservatory on it. It's crazy.
But of course that led to the subprime crisis and the financial crash.
I don't see that coming back anytime soon. Having said that, there are a couple of really niche things you can do. If you've got a family member that's prepared to put the additional 10 or 5% into a savings account with that same bank and not touch it for a while, the bank will lend you 100% of the value of the property because you've got that money. They've got that money spare, or there's a charge potentially over a parent's house or an older brother or sister's house.
Okay.
So there are some things you can do, but they're few and far between. Like I say, lots of additional risks. Solicitors need to be involved. You need to really be sure that you know what you're signing up for or what favour you're asking your mum or dad to do.
Let's just talk a bit more about that, because I think it's probably quite in use a lot at the moment. Isn't Bank of Mum and Dad one of the 10th biggest lender or something like that?
Bank of Mum and Dad is the 10th biggest lender. Bank of Mum and Dad represents, I think, something like 60% of all deposit funds that goes in. Go. So
it's huge. Yeah, it's a huge part of the market. Any sort of words of advice for mum or dad?
For mum or dad? No, just check inheritance tax liability when you're gifting money to children. Obviously, always consult a tax expert, an accountant, someone like that. If you're lending, you need to demonstrate that it's a gift and not a loan, actually. Yeah. And so, if you are gifting to your son and your son's partner, it's money to both of them. So you need to be happy with that situation as well.
Yes. Good point. But as mum or dad gifting the money, you are going to be linked to the loan.
Not if you're gifting the money.
Just the deposit.
That's the reason why we specify that it's a gift, because then the mum and dad don't have any part to do with the mortgage. What they can do if they wanted to go a different way is they could actually go on the mortgage and sometimes help increase affordability. So house prices obviously are more than the average mortgage is about 4.5 times someone's salary.
Okay.
You may need a parent's income, which is a bit higher, to go on it with you. So mum or dad could jump on the mortgage with you and help you with the affordability calculation.
And would they then be registered on the title of that property?
There's two ways about it. You could do a standard mortgage, joint mortgage, much like two partners could, or you could do a mortgage where the parent is on the mortgage, is liable for the debt, but is not named on the title deeds of the property, and therefore the child then has a bit more independence and owns the property outright.
But a fair degree of responsibility as well, because if the child defaults or doesn't pay the mortgage, actually the mortgage company is going to come straight for the parents.
The parents' house, parents' savings, anything like that. So you need to be confident and you need to be able to trust your family.
Useful info, thank you. Can we talk a bit about the latest government schemes? Because there are some great schemes out there, and they seem to come and go. And whilst I absolutely welcome all schemes that help, there are some that are more helpful than others. What do you make of them?
The most common one we see is help to. First of all, what I make of them, if you can afford to do it yourself without any use of these schemes, then do that, because it's much easier. You have access to more lenders. It's an easier process. But if you can't quite get that deposit together, or your financial situation, your family's financial situation isn't such that you can afford to get on the property ladder, you can look at other schemes. So the Help to Buy is the most common one that we see, I think mainly in England, and there's a similar one in Scotland. But the government will actually give you an interest-free loan towards the deposit of the property for a period of 5 years. So your mortgage is normally split into your deposit plus a mortgage. In this case, it's your deposit, the government loan, and then the mortgage. So whilst it might seem great to begin with that you've got an extra 20% cash in the bank to afford this property, you need to know that you're going to have to start to pay that back at some point. And whether or not you pay that loan back when you sell the property, or you start to pay it back as a monthly payment as a loan in 5 or 6 years' time, just be prepared that that money has to be paid back. It's not a gift.
Is it? And I may not have thought this through correctly, but is that the Treasury banking on house prices rising? Because if they fall, they won't get their money back.
If they fall, they won't get their money back. I think it's it's broken into smaller businesses that lend that money. I don't know if it's coming from the Treasury specifically.
I see.
But I think that
interesting.
The prediction is that house prices will continue to go up. Otherwise, they wouldn't be offering these loans.
And given that the powers that be can affect what happens, massively affect what happens in the housing market. What have we seen through lockdown and stamp duty and the stimulus that's had? They can change things to stimulate the market.
They can, but then stimulating the market also means that it's increasing house prices, which means that it makes then harder for new first-time buyers to go on the ladder, and also be aware that you're paying stamp duty on the full amount of the property, including that loan. So there's more.
So many variables.
So many variables.
But that's what makes it an interesting world to operate in.
It's very interesting. It changes all the time. The job's never the same from 1 month to the next.
You've got to keep up to date.
Definitely.
I've just got to keep up with Kirsty. Tom, that's really interesting. Can I just ask one final question, if I may? Lots of people have been asking us at Move IQ about shared ownership. Is it a good thing? Isn't it a good thing? And there's so many schemes, and they're all a bit different. But have you got any general thoughts and advice on whether it's a good idea or not? Yeah,
shared ownership is good for the right people. So again, if you can afford a property outright without using this scheme, then I would always suggest to do that. But if you can't quite get the deposit together, or your income isn't enough to obtain a mortgage to buy a property outright, then shared ownership is a great way to get a foot into the door, because you'll buy a percentage of the property. So typically, if you're only buying 20% of the value of the property, you would need a smaller deposit. You would need to have a smaller income,
and then you rent the remainder.
So you've got to be able to. Sometimes it's not cheaper on a monthly basis because you've got your mortgage to pay as well as rent, and these typically are sort of new build flats that come with additional service charges and ground rent and things like that. So you need to factor in all these, and then there's another party involved in your application, which is the housing association, who have their own questions and their own judgments and their own paperwork to fill in. So it does make it more complicated.
But the purpose of these shared ownership schemes is to enable you to staircase and to buy more of a greater share of your property and end up owning the whole thing.
Absolutely. You can, as your career develops or potentially you save money, you can buy an additional share in the property over a course of 20, 30 years until you own the whole thing. Or you can decide if that property's gone up in value to a certain extent, you can sell, cash out, you've got a bigger deposit to put down for your own place later on.
And there's no difficulty with that when it comes to sell?
There are further complications when you sell a shared ownership property because the housing association still hold a charge on that property. Yeah. It has to go through their estate agents. They need to vet potential buyers. So it's not like you can just wander into an estate agent on the high street and sell it to whoever you want to. You've got to go through additional checks.
So cutting to the chase, Tom, on the topic of shared ownership, they are a great scheme for certain people,
yes.
Not everyone. And there are good schemes and less good schemes. So basically read the detail and get properly comfortable with it. Take some advice.
Yeah, read the detail. Speak to a good solicitor that specialises or has experience in dealing with shared ownership.
Got it.
And get some independent advice.
Tom,
always.
Great to see you. Thank you for your time. Really helpful.
Thanks, Phil.
A few words of warning. Your home may be repossessed if you don't keep up repayments on your mortgage. You may have to pay an early repayment charge to your existing lender if you remortgage. Individual savings may vary, and terms and conditions can be found at Trussle.com.